Hello everyone, my name is Anita Francis and I will be your faculty for the paper Financial Management. This is a small demo video on one of the most interesting topics in our subject, Financial Management. So throughout this paper, you have to think yourself as a finance manager, and that will make the work easy here. So as a finance manager in a company, you have n number of responsibility. The primary one being profit maximization of the owners. But having said that, let's not go there. Another important aspect as a finance manager is management of working capital. Management of working capital. Now, let me tell you what all things are included in working capital. These are your current assets and current liability. So basically, managing working capital is managing current assets and current liability. And in current assets, I hope you know that we have inventory, we have trade receivable and cash. And in current liability, mainly we have trade payable. So for the demo video, I have very specifically selected managing accounts receivable or trade receivable. So let us go back to a little bit of background here, okay? So when does a business have a trade receivable or what results in a trade receivable? So this is something that most of you are aware of. But anyways, if you have taken an exemption and this is maybe your first paper, so for those students, keep in mind, as a business, you sell goods to customers. You have two options here. You can make them pay ready cash or upfront payment, upfront cash payment. For us, it is cash receipt, or you can provide credit facility for them. So whereby they can settle the amount at a later date. Now, if you receive upfront cash, then there is no chance for a receivable. If you provide credit facility, till the time they settle their liability, this particular customer is your accounts receivable, or we call them as our trade receivable, which is an asset for a business. And the current assets because it is to be settled within 1 year. So this is the background. So credit sale results in trade receivable. So when a business has credit sale, it results in trade receivable. Another aspect to keep in mind is what are the risks associated with credit sale? Risk associated with credit sale. Because if it is a cash sale, there is not much of a risk because you are getting the money immediately. So there is not much of a risk. But if you're making a credit sale, there is actually a risk of liquidity issue for the business. So liquidity issue means some cash flow issues for the business. Say you made a sale on 1st January 2003. If the customer has agreed to make the payment by end of January, by 31st January 2003, during this time frame, if you happen to have an emergency cash requirement and you don't have enough money because your money is blocked as trade receivable, which will only be settled by the end of the month. In that situation, you will face some difficulty in paying your cash requirements. Maybe that will be salary or paying your suppliers or any immediate cash requirement. And you will have some liquidity issue there. Another risk associated with credit sale is, what if your customer default the payment or they are not able to make the payment within the prescribed time, which can result in something known as irrecoverable debt. So there is always a risk of irrecoverable debt, or very commonly known as bad debt. So this is a situation where you will have to write off the entire receivable or whatever amount of receivable that you will not be able to recover from your customer through credit sale. So there are two risks associated with credit sale. So does that mean you can completely cancel out credit sale from a business? So is the solution to cease credit sale? Do you think that will work? Never. You think of an example. There are two companies, company 1 and company 2. Okay. Company 1 only offers cash sale. So we can call them, they are risk averse. They don't want to take the risk of liquidity issues and bad debt. So they decided that they will only provide cash sale. On the other hand, company 2 is providing both cash plus credit sale as well. So you can call them as risk takers. Okay, they are ready to take a little bit of risk here. Keep in mind, both products are standardized. Okay, there is nothing unique about the product. Both of them are giving the same product as well. So what is the risk associated here? Yes, for company 1, they will not have the risk of bad debt and liquidity issues for the time frame. For company 2, yes, they have liquidity issues. They might have liquidity issues. And also there is a risk of bad debt. But if you notice, as a customer, where will you go? You will like to go to company 2. Since both the products are same, you will prefer to go to company 2. So all the customers will go to company 2. Everyone will be interested to go to company 2 because they are providing credit facility. So even though there is an issue of liquidity, which there is a risk of liquidity issue, profitability will increase. So what happens is your revenue will increase here. Your sale is increasing. So your profit can also increase here. But for company 1, they will have profitability issue. They will have profitability issue. So as a business, you have to strike a balance between managing your liquidity issue and profitability issue. So as a finance manager, your objective is to strike a balance, an optimum level without compromising liquidity and profitability. So the idea that I've tried to portray through the note is the optimum level of credit, trade credit extended represents a balance between two factors. So if you are a good finance manager, you have to come up with a credit policy that equally balances liquidity and profitability. So you should be able to collect the money from the receivables as early as possible in order to avoid the cost of financing. Okay, so imagine a situation where your customer told that they will pay within 30 days and they did not make the payment in 30 days. They will only pay after another month. So if you have a cash requirement, you will have to take a bank OD. And you know that a bank OD will result in interest payment for you. Maybe 10% interest payment for you. So collecting the money as early as possible will reduce the cost of financing. But if you pressurize your customer to make the payment as early as possible, they will look for alternative suppliers and they can switch, which will result in profitability issue. So you have to maintain liquidity, but at the same time, you have to manage profitability as well. So extending the credit period to customers to encourage additional sale, you have to encourage sale, but at the same time, you have to reduce the cost of financing. So you have to bring a balance. And that's basically what, as a finance manager, one of your responsibility. Now, there is a theory aspect which gets tested for the examination. So as a student, sorry, when you approach FM paper, never see it as a numerical paper. See it as a 50-50 situation. So it is a 50% theory and a 50% numerical paper. Okay. Now, coming to the theory aspect, one of the important theory portion of FM is elements of good credit control policy. So as a finance manager, you will have to set a credit control policy which balances liquidity and profitability of the business. So what are the elements of a good credit control policy? I've included the points. You just need to remember the points and you can build it into a complete sentence, maybe 1 or 2 sentences during the time of examination. So remember the points and try to elaborate in your own words, not more than 2 sentences, maximum 1 sentence, depending on the mark. So first element of credit worthiness is when a new customer approaches you, you should not right away provide credit sale. You should first assess their credit worthiness. Now this applies for new customers as well as existing customers. But for existing customers, this process is much easy. Why? Because you can analyze their previous payment record. You have their payment record. You have their payment pattern. You can check whether they used to make the payment on time previously. So that is the case with existing customer. That's how you can evaluate the credit worthiness of existing customers. But how can you evaluate the credit worthiness of new customers? So they are new to us. So there is a lot of risk. We are unfamiliar with them. So you can reach out to credit rating agencies. There are n number of credit rating agencies. As Indians, you might be familiar with Civil, CRISIL. Okay. Internationally, 95% of the financial markets is held by Moody, Standard and Poor, and Fitch. And there is Dun and Bradstreet and plenty other as well. So you can reach out to credit rating agencies who will do the work for you. So they will evaluate the credit score of the customer based on their transaction history and give you a report on that. Ask for trade and bank references from the new customers. You can ask the customer to provide trade and bank references. You can ask the customer to submit their financial statements if it's a large customer. Also, you can ask them for their bank statement as well. So you can ask them to submit their bank statement for the previous 6 months, okay? Depends on the situation. So this is how you evaluate the credit worthiness of a customer. So what did you check here? You checked whether the customer is eligible for credit sale or not, whether they have the capacity to make the repayment. You evaluated their capacity to make payment in future. The second part is credit terms and settlement discount. So you have evaluated you find it a satisfactory profile. So you're planning to extend credit sale to this particular customer. Now we have to set the terms and conditions. So that includes setting a credit period. So what is the prescribed number of period that you are planning to provide credit to this customer? So what is the time they will get to make the payment? Is it 10 days, 30 days, 60 days, or 90 days? And this varies from customer to customer. You can set a credit limit. So out of the total sale, how much percentage is credit or how much percentage is cash? Or what is the maximum amount of credit they can avail? So you have to set it. You have to get authorization for this limit from a personnel, and you have to set the credit period and the credit limit. Also, they must very clearly specify any settlement discounts and whether to give any early settlement discount to the customer. So how does early settlement discount works? I'll tell you later in this video. Just keep that in mind. And when you evaluate that, you should check whether the benefit outweighs the cost. So there is always, as a finance manager, your focus should be on benefit and the cost. So if you provide settlement discount, does the benefit outweigh the cost, or is the cost above benefit? You have to evaluate, and then only you should decide whether to give the settlement discount or not. Ensure that the customers are aware of terms and settlement discounts by printing them on the orders or invoices. That is also very important. Ensure that any authorized discount policy is enforced. So the idea is pretty simple. You can set the terms and conditions of that credit sale, but all of them should be authorized. Third point is, so you have given the credit sale. Now the next one is a collection stage. So you have given them a credit period, let's say 30 days. So for 30 days, you will not be bothering them. But on the 30th day, that becomes the due day, you expect them to make the payment, or they're supposed to make the payment before 30 days or on the 30th day. On the 31st day, the balance is overdue. The due date has exceeded. So you should have a clearly set out procedure to be followed for the collection of debt. So you should be sending them gentle reminders, Gentle reminders are in the form of phone calls or letters or emails, messages, chasing phone calls. Then demand letters are formal letters which request or commands the other party to perform their obligation. Whatever they have agreed to do, you have to ask them to do it. And if they don't do it, we can move legally, and there is a document. This is the document that we can say in the court that we've actually given them we've actually requested for the payment, but they have not made it. Now, we can see supplies until the outstanding amounts are settled. Okay, if you're still providing credit sale to them, you can stop that and you can ask them, if you want any more supply of goods, you have to settle the outstanding amount. And you can decide when outside assistance is needed. So the outside assistance here is basically collection agencies, lawyers, or you can even opt for factoring. Factoring is a situation where you sell your trade receivables to an agency who will then take the responsibility of collecting the amount on your behalf, where you will get a sum amount from the collection agency from the sale of this trade receivable. So now the risk and the returns rest with the agency. You are getting a bulk amount on the basis of the trade receivable. And in the worst case scenario, you can go to legal action as well. And if a system is implemented, if terms and conditions are set, and if there is a collection procedures arranged, there should be monitoring of the system as well. So monitoring of the system can be done in multiple ways. You can calculate ratios and compare it with the previous year or the industry average. The ratio here is trade receivable collection period. Okay, I hope you remember, which is your trade receivable divided by your sales revenue into credit sales. Credit sales into 365. Then you can use some statistical data to check whether these policies are working effectively. Then you can start charging interest for outstanding amount, maybe on a daily basis. Usually businesses do it on a daily basis, but your calculations would probably be on a monthly basis where you time a portion. And age receivable analysis. So age receivable analysis is basically a report which categorize your trade receivables on basis of age. So it's not their physical age we are considering. How long this particular receivable have been overdue. Okay, so how long it has exceeded the due date? Is it 10 days, 30 days, 60 days, 90 days? You categorize them. And the high risky category is the more days you're due, the more days you're overdue, that situation, in that situation, you're a high risky profile. So we have to focus on that particular customer. We have to chase the payment from them. And there is a risk that can turn into bad debt if it's still not recovered. So that was the main aspect of a good credit control policy. Now, I just also want to include a calculation bit here as well. So the calculation part of managing receivable, there are plenty of calculations involved here. I'm just going to look at one aspect, which is early settlement discount. So anyhow, when you do managing receivables arithmetical calculation, most questions in the examination relating to receivable management involve consideration as to whether a change in collection policy is worthwhile. Okay, so you have a collection policy in your business. That collection policy can be in terms of credit limit, in terms of credit period, or in terms of early settlement discount provided. Okay, early settlement discount, I can say allowed. So you will be asked in a question, is it really beneficial for the business to extend the credit limit, extend the credit period, or provide early settlement discount? When you get a question like that, you will do a cost-benefit analysis. You will evaluate the cost and the benefit associated with that scheme. And by common sense, the benefit has to exceed the cost in order for you to move forward with the policy. So that is a cost-benefit analysis. So let us move to what is early settlement discount. So when you make a credit sale, normally there will be a credit period. Okay, there will be a credit period. So you will set a period for them to make the payment. That maybe let's take it 30 days. So imagine a situation you have to wait for 30 days to get the payment. So how about you change the terms like this? In the new year, you're going to tell them, if you pay within 5 days, okay, within 5 days, you will get a 10% discount on the invoice bill. So on the total amount that you're supposed to pay, you will get a 10% discount only if you pay within 5 days. So you don't have to wait for 30 days. Customers who want the 10% discount will immediately pay within 5 days, or they'll try to arrange fund within 5 days so that they can make the payment. So the benefit here is you are encouraging your credit customer to pay early. Okay. So you are encouraging your credit customer to pay early. So this is the benefit of early settlement discount. I hope you understood the concept. So you are asking them to pay before the normal credit period. So you anyway give them a credit period, but you're asking them to pay way before the credit period, for which they will be given a discount of so and so percentage. Now you are planning to implement a proposal like this. So before implementing, you can't simply implement this proposal. First, you have to evaluate what is your cost. As a business, what is the cost that you're going to incur and what is the benefit you're going to incur? You have to compare this. Now just think about it. What is the cost that you will have to incur? Okay, the cost is the 10% of the revenue that you're sacrificing. So let's say out of your total sale of 100,000, 35% has opted for this particular discount. Then from that 35%, you're losing 10% of your revenue. So the discount allowed is the cost here, or the revenue lost is the cost here. I don't know the amount, that is the cost here. Okay, so you have a cost. Likewise, you have to do a comparison of the benefit. Now, benefit is a lengthy calculation, which I will discuss with a question. So let me just tell you how you calculate. What is the concept behind benefit? Like I told you, I made the sale on 1st January 2003. Ideally, there is a 30-day payment period. So they can wait up to 30th January 2003. They have time to make the payment. So imagine in this time frame, if I immediately get a cash requirement, I don't have the cash because my cash is blocked as trade receivable. I'll have to go to a bank. I have to take an overdraft. And if I take an overdraft, I have to pay interest. But if you ask them to pay within 5 days, okay, you're asking them to pay within 5 days. You don't have to go to the bank. You don't have to take an overdraft. You don't have to pay interest. So basically the benefit is the interest that you save on reduced receivable. It is the interest that you save on reduced receivable. So basically you are comparing the discount allowed and the interest that you might save on reduced receivable. So the idea is clear. I hope the idea is clear. The way you take the benefit is, if you had to wait for 30 days, you have an emergency cash requirement, you will have to go to the bank, take an overdraft, pay interest. If the customer pay the money much earlier, you don't have to take a bank overdraft and you can save your interest cost as well. So now you will have to do numerical calculation of the cost and the benefit. You have to compare. If the benefit is higher than the cost, you will say they can proceed with the proposal. If the cost is higher than the benefit, you should not proceed with the proposal. So I will just explain it with a question that I have set here. This is a question from your BPP kit as well. Valdez company has an annual credit sale of 4,500,000. The annual credit sale is very important. Okay, please keep in mind this is very important. And on average, customers take 60 days to pay, assuming a 360 day a year. So it is not 365. They're asking you to assume 360. So don't miss out on these small elements. On an average, the credit period is 60 days. So normally customers take 60 days. Now, I will also tell you one more thing. Imagine a situation where in the question they don't give you this information because we need it. Okay, the 60 days is something that we need. So imagine a situation where they don't give you the 60 days in the question. How will you find out the average payment, payment date of a customer? You simply need to calculate the trade receivable collection period, which is equal to trade receivable divided by credit sale into 365. This is giving you an average of the number of days a customer takes to make the payment. So if this 60 days is not given in the question, you will have to, here you have to take 360, okay? So normally it is 365, but it is clearly said in the question you take 360. So that's why you have to take 360. Likewise, you can also calculate your number of days as well. If it is directly given, don't bother about it. As a result, Valis has a trade receivable balance of 750,000. So if a customer is allowed to take a discount of 60 days, if the customer is allowed to pay and they have a time frame of 60 days, this is your total receivable. So you have a lot of receivable because it is 60 days time frame. So they will only pay after 60 days. So you have a huge receivable here. You have money yet to be received. Company relies on an overdraft to finance this at an annual interest of 10%. So this is your interest. In this time frame, if you have a cash requirement, you'll have to go to the bank. You have to take a bank overdraft, but you have to pay an interest of 10%. Lalis is considering offering an early settlement discount of 1% for payment in 30 days. So instead of 60 days, if they pay within 30 days, those customers will get 1% discount. It is expected that 25% of its customers, we don't need this percentage. Always keep in mind, all your calculations should be based on your annual credit sale. Okay, so representing this 25% of the customer is 35% of your annual sale. So you should take 35% into 4,500,000 for your calculation. Please keep in mind, always do the calculation based on your annual credit sale and percentages based on that as well. So they are assuming that 35% of the credit sale, okay, those many customers will pay within 30 days. So if they pay within 30 days, you have to give them a 1% discount. If Valis company introduce the proposed discount policy, what will be the net impact? So we need to check whether the net impact is, whether the cost exceeds the benefit or whether the benefit exceeds the cost. This is what we're going to check. So net impact we are going to check and we are going to give them a suggestion. So how to approach this question? I'll give you a format. Okay. So when you're given a question like this, one heading will be for benefit. So the benefit is the interest saved on reduced receivable. Okay, I'm giving you a format to help you. And this reduced receivable is a working note that you have to do. Second part is the cost. Cost is the discount allowed. That is the discount that you are allowing. I think cost we can do first because that is the easiest one to do. So I'm just going to do the cost calculation here. So the cost is equal to, of the 4,500,000 credit sale, 35% of the customers will avail discount. That means you will have to lose your revenue by 1%. So keep in mind always your calculations based on your annual credit sale. So that means you will incur a cost of 15,750. Make sure you put it as a negative symbol, okay? Now we need to find out the benefit. So in order to calculate the benefit, it is the interest that you're saving. So I know the interest is 10% into reduced receivable. So what is reduced receivable? How do you do the calculation of reduced receivable? It is a working note. So you have to do it as a working note. So you go further. Okay, so you go further. I'll just do it in a different sheet. So reduced receivable. So first you have to take your calculation of reduced receivable. If you get the figure, then we can just multiply it with 10% and we'll get your benefit. So that is the amount of interest you're going to save. So for that, you have to first calculate your current trade receivable. What is your current trade receivable? Without implementation, before the implementation of this discount policy, before the implementation of discount policy, you don't have to write all this in your examination. Okay, you just need to write current trade receivable. So currently your trade receivable balance is I think it's given in the question as 750,000. So before the introduction of this discount, customers normally take 60 days to pay, and in that 60 days time frame, the business is having trade receivables of 750. So you'll have to come back here and you have to write your current trade receivable is 750,000. Okay, now you have to take the revised receivable balance, revised receivables. So this is after implementing the discount policy. I told you your calculation should be based on the idea that all the calculations have to be done on the annual credit sale. Okay, so here, after the implementation of discount, there will be two category of people. Those who take the discount, okay, there will be customers who will take the discount and who does not take discount. So out of your 4,500,000 credit sale, 35% customers will avail the discount and they will pay within 30 by 365. So they will pay within 30 days. So this is 360, not 65, 360. So that means it is 131,250. Then, who doesn't take the discount out of the 4,500,000? If 35% avails the discount, the remaining 65% will not take the discount and they will take the average 60 days to make the payment. So the new receipt, there it is 487,500. So your totally revised receivable is equal to 6,18,750. So if you notice something here, because of the introduction of the discount policy, you can see that your receivable balance has decreased. So the sum of this is 6,18,750. So after the introduction of the discount policy, what happened is that your receivables have reduced from 750. So on an average, if the customer takes 60 days to make the payment, your total receivable is 750. If you implement the discount policy, your customer or your receivable will be 6,18,750. There is a reduction. So what is the reduction in receivable? So the reduction in receivable here is 131,250. It is 131,250. What does this reduction in receivable indicate? This is the money that you got. So normally it is 750, but if you introduce discount, your receivable is 6,18,750. So why is there a difference? The difference is because you receive the money. You receive this much money earlier. Okay. So that is the idea behind this reduction in receivable. This is actually the cash that you received. So imagine if you receive 131,250, you have cash with you. You don't have to go to the bank. You don't have to pay an interest. So you are saving interest of 10% on this 131,250. So the benefit, the benefit here is, the benefit you have here is 10% into 131,250. So the benefit is, just a minute, 13,125. So now I am going to do a comparison. So the benefit of providing this discount is 13,125. The cost is 15,750. So the net impact is, it is a net cost. It is a negative figure. It is a net cost of Let's calculate the net cost. 2625. So it is a net cost of 2625. As a finance manager, will you suggest to continue with the scheme? I won't do it. I will not implement the early settlement discount because I realize that, okay, I am having a benefit of 13,125, but I'm incurring a cost of 15,750. So I don't want to have excessive cost over benefit. Always the benefit has to exceed the cost in order to proceed with the policy. So my conclusion will be to not move forward with this policy. I hope this idea is clear. Okay, so you compare the benefit with the cost. Cost is always your total annual sales into the percentage of people who are willing to take the discount, and you are supposed to take it as part of your annual sales. Okay, all the calculations should be based on annual sales, which is 35% into 1% discount you have to give them. The benefit is that from the money that you receive from this discount policy, that money you can save interest on that. So you receive 131, 250 early. So what is the benefit? You can save 10% interest there on that as well. So I'll just show you the previous calculation. This is how you do a reduced receipt. This is basically a working note, guys. This is a working note. You take your current receivable, which will be given in the question, or else you can use your trade receivable days to get the answer. If your 60 is your existing, 60 is your normal average receivable days, and if 4,500,000 is your sales, you can calculate your current trade receivable. Then revise receivable after implementing the discount. People who take the discount, does not take the discount, the sum total is the new receivable balance. There will definitely be a decrease or a steep dip in the amount of receivable. That decrease indicates the cash that you receive. So for this cash, you don't have to go to the bank, take a bank overdraft or pay any interest. So you're saving interest there. So this is a standardized calculation. Easy, conceptually oriented, but easy as well. Hope you understood it. Hope you found financial management interesting as well. I've included a little bit of theory and numerical for your understanding. So hope to see you guys for the live session. Bye guys.